Imagine owning a piece of the world's biggest companies for the price of a cup of coffee. Sounds like a dream, right? But for most new investors, the stock market feels like a confusing maze of risks and jargon. That's where ETFs come in. I've seen so many people lose money simply because they didn't know the basics. I don't want that to be you. Today, we're breaking down the 10 essential things you must know before buying your first ETF. Let's build your future together. Number 1. What actually is an ETF? Most people overcomplicate this, but it's actually quite simple. Think of an ETF or exchange-traded fund as a basket. Inside this basket, you have multiple ingredients. Instead of buying just one stock, you're buying a tiny slice of everything inside that basket all at once. And because it's exchange-traded, you can buy or sell it throughout the day, just like a single stock. This is a huge advantage over mutual funds, which only trade once a day after the market closes. 2. The hidden cost of investing, the expense ratio. This is the fee the fund manager takes. It might look small, like 0.05%, but it acts like a leak in your bucket over time. Over 30 years, a high fee can literally steal tens of thousands of dollars from your retirement. Always look for passively managed index ETFs. They usually have the lowest fees in the industry. Lower fees mean more of your money stays in the market, compounding for your benefit. 3. Instant diversification. This is the secret sauce of ETFs and your biggest safety net. If you buy one stock and that company fails, you lose everything. It's the all eggs in one basket problem. But an ETF like an S&P 500 tracker spreads your money across 500 of America's largest companies. You can even diversify globally or by sector, like technology, healthcare, or green energy. Diversification doesn't eliminate risk, but it significantly smooths out the rocky ride of the market. 4. Understanding liquidity. This determines how easily you can turn your investment back into cash. Some niche ETFs are like selling a rare antique. It takes time to find a buyer at the right price. Major ETFs are highly liquid. There are millions of buyers and sellers active every single minute. Check the average daily volume. If it's in the millions, you generally don't have to worry about liquidity. High liquidity means you can access your money whenever the market is open without a headache. 5. The power of dividends. This is the passive income part that everyone loves. The ETF collects dividends from all the companies it holds and passes them through to you. You have a choice: take the cash for your expenses or use a drip to automatically buy more shares. Reinvesting dividends is one of the most powerful ways to accelerate your wealth creation. It's like planting a seed that eventually grows into a forest that feeds you for life. 6. Tax efficiency. This is a technical point, but it saves you a lot of money in the long run. Mutual funds often sell stocks internally, which can trigger capital gains taxes for you, even if you didn't sell. ETFs use a unique in-kind creation and redemption process that minimizes these taxable events. This means you keep more of your money working for you rather than handing it over to the taxman. Always look at your after-tax returns. That's the money that actually ends up in your pocket. We're halfway through. If this is helping you, please hit that subscribe button. It helps us reach more people. Remember, we're not just talking about numbers. We're talking about your freedom and your family's future. 7. Order types. This is where most beginners make their first big mistake. A market order says, I'll buy it at whatever the current price is. But prices can spike in an instant. A limit order lets you say, I only want to buy if the price is X or lower. This puts you in control. During volatile markets, using limit orders is a non-negotiable rule to protect your capital. It might take a few extra seconds to set up, but those seconds can save you hundreds of dollars. 8. Watch for tracking error. This is a measure of how well the fund is actually doing its job. If an ETF tracks the S&P 500, its performance should be nearly identical to that index. A large gap or tracking error means the fund manager isn't managing the portfolio efficiently. Top-tier funds from major providers usually have a tracking error so small you'll barely notice it. Always check the historical performance against the benchmark before you commit your hard-earned money. 9. Check the holdings and weighting. Not all ETFs are created equal, even if they have similar names. Some ETFs are top-heavy, meaning just a few giant companies make up most of the fund's value. Others are equal-weighted, giving the same importance to smaller companies as the giants. You might think you're diversified, but if your ETF is 40% technology, you're heavily exposed to that sector. Know what's under the hood. It takes 5 minutes to check the top 10 holdings online. 10. Adopt a long-term mindset. This is the most important rule of all. The market will go up and down. There will be headlines that try to scare you into selling. Success in ETF investing isn't about timing the market, it's about time in the market. Compound interest is the 8th wonder of the world. Let it work its magic for you over decades. Your future self will thank you for the discipline you show today. Stay the course. Let's recap. First, remember an ETF is just a basket of securities. Second, keep those expense ratios low. Third, lean into instant diversification. Fourth, ensure the fund has high liquidity. Fifth, use dividends to your advantage. Sixth, appreciate the tax efficiency of the structure. Seventh, always use limit orders. Eighth, keep an eye on that tracking error. Ninth, know what's in the basket. And 10th, never lose your long-term focus. Investing is about more than just money. It's about the life you want to build and the impact you want to have. You have the tools now. The next step is simply to begin. I believe in your financial journey. If this video helped clarify things for you, please give it a thumbs up and subscribe to our channel. We release new educational guides every week to help you master your money. Thanks for watching. And here's a quick bonus tip. Consider automated investing through a robo-advisor if you want a hands-off approach. Many platforms now offer low-cost ETF portfolios that rebalance themselves automatically. Investing involves risk, and past performance is never a guarantee of future results. Play it smart. I'll see you in the next video. Until then, keep learning and stay disciplined. Goodbye. Connect with us on social media for daily tips and market updates. See you there. One last thing. Thank you for spending your time with us. Your attention is your most valuable asset. Use it well. The sky is the limit when you have a plan. We'll be here to help you every step of the way. Cheers! Actually, let's take a look at one more thing before we go. Most people forget about the power of consistency. Even $50 a month, if done consistently over decades, can change your life. Never underestimate small steps. You are building a legacy, one share at a time. Be proud of the work you're putting in today. It matters. It's time to take action. Open that account, do your research, and buy your first share. You've got this. Don't forget to like this video if you haven't already. It really does make a difference for our channel. The world is full of opportunity. Go out there and claim your slice of it. Happy investing! As we close this chapter, remember that knowledge is the best interest you can earn on any investment. Stay curious, stay humble, and most importantly, stay invested in yourself. You are worth it. This has been an educational guide for the modern investor. We'll see you in the next one. Take care.